Okay, accounting students, this is truly the last chapter of the semester, our chapter 13, where we're going to be learning the auditing of governments and also non-profit organizations, tax rules for non-profits, and some performance ratios to evaluate government. So there's two videos, one for auditing and the second one covering tax and performance evaluation. Let's take a look at auditing. So if you truly plan to become a CPA, you know you have to pass a CPA exam. And one of the tests in the CPA exam deals with auditing. So if that's the case, you should be taking our class called BUSA 415 Auditing, where you're going to spend the whole semester on this interesting topic where we only cover it in half a chapter, half of this chapter 13. So in that 415 class, probably you're going to be focusing on the auditing rules created by the um, Public Company Accounting Oversight Board that creates rules for public corporations, public businesses, businesses that have their stock sold on stock exchanges governed by the Securities and Exchange Commission. But most businesses don't sell their stock on stock exchanges, especially here in Hawaii where there's a lot of small businesses. So we have the Auditing Standards Board created by the AICPA that has generally accepted auditing standards. But we're not a business here in our 414 class. We're governments. We need to follow government auditing standards. That's under the guidance of the GAO. So the GAO adopts this GAS created by the Accounting Standards Board and adds a few more rules on top of that, which includes that the auditor has to be knowledgeable in governmental accounting. You know, all that stuff we're learning this semester. And audit reports of the governments have to be publicly available, usually posted up at the government's websites. When you do an audit, you usually have to evaluate the internal control systems of that organization. In the case of the government, this evaluation has to be written up, has to be in writing. Now, this is not an audit of the internal control system, but it's probably more a detailed analysis in writing that's provided in the audit report, more so than you would see in an audit of a business. The working papers, all of the audit work, is something proprietary to the auditor, to the CPA. So it's usually not made public, but it has to be available to federal agencies, federal authorities who want to look at it. Again, even though we're following the GAO rules, this applies to all governments, federal, state, local governments. And all of these rules combined together is called the Yellow Book. And there's a link in our Chapter 13 Laulima Resources folder linking to a draft, updated draft for 2017 of this Yellow Book. Now, when you have an audit, the most common type is a financial statement audit, where the CPA is expressing an opinion. Even though you see the word assurance here, they're not guaranteeing, they're not ensuring anything, but they're expressing their professional opinion whether the organization's financial statements, not the organization itself, but the financial statements, present fairly. And this is the key phrase here, presents fairly what's happening in the organization. The word material means if something is immaterial, so small that it doesn't affect the user of the financial statements, then it doesn't matter whether that immaterial item is something bad, a crime, a mistake, an embezzlement. Yeah, because it would be immaterial, it's not going to affect whoever's using the financial statements. So it's kind of like a rounding item here. If something is uh, uh, $1,000, $10,000 mistake or error, but you're dealing with millions or billions of dollars in a financial statement, that small error, that small crime, even though it's illegal, is not going to affect the fair presentation of the financial statements. Okay, so this is the main thing most auditors audit, the financial statements, a financial audit. Other things that the auditor can audit is also the internal control systems. And again, this write-up mentioned over here on this previous slide is not an audit of the internal control system, but just an analysis of how in-depth the scope of the financial audit is going to be. Now, if you do want to have the internal control systems audited, that's a separate engagement, a so-called extra charge they're going to have. Other things they can audit is compliance. And again, you have to comply with the laws, with the rules set out to make sure that things are happening accurately on the financial statement, but it doesn't ensure, it's not the focus here, yeah? The focus again over here on the financial audit is the financial statement. A compliance audit will only focus on whether the rules or the regulations are being followed. Here's projections being audited. Here's more specific items. The single audit that we mentioned later, or maybe even sales audits for businesses would be something like this type of audit here. Different from a financial audit, sometimes you hear the term management audit. They're auditing the efficiency, the effectiveness of an organization, and not necessarily what's being reported on the financial statements. Um, let's see. So if you're a working for a CPA firm, generally there's different departments. For large CPA firms, the big one would be auditing, attestation, and another one would be taxation, my personal favorite. And then the third would be this area down here, the so-called consulting, uh, management advisory services. Yeah, and right now this is the big money maker for CPA firms, especially the big ones that offer things like cyber security, consultation, technology, accounting systems, advising and installation. Okay, that's the consulting here. Again, we're focusing here in this chapter on audits. And more specifically, financial statement audits, financial audits. The auditor is expressing an opinion. Now, this opinion could be the whole government, the so-called government-wide, or a specific unit, a specific fund, a specific program. Maybe one auditor is doing one program, one unit, but another auditor is doing the so-called government-wide audit. So that government-wide auditor would be using the referring to the opinion of another auditor, and that would be referred in the opinion of the auditor for the government-wide audit. So if you're in auditing, one of the main things you'll be doing is testing transactions. Again, you would first look at the internal control system of the organization to determine how good it is. And the better it is, the less testing of transactions you have to do. Of course, with technology and big data, uh, if this type of testing possibly can be done more easily with, of course, computers. Um, you're going to have to do things like confirmations with vendors, with customers, with banks, financial institutions, possibly with attorneys, trying to confirm again with other parties what's happening with the target organization here. And ultimately, the auditor is going to express an opinion not on the company, but the financial statement reporting on the company, and not guaranteeing accuracy, but determining whether the financial statements fairly present. I always look for this word fair, yeah, in the opinion, according to the accounting rules we've been learning throughout all our accounting classes. So when an auditor gives an opinion, there's four different possibilities. The best one is unqualified or unmodified. Again, you're looking for that fairly present in this opinion, and there's no conditions. Unqualified, unmodified. Now, if the um, situation for the company has something that's not necessarily immaterial, that's not following accounting rules, then we can still say it fairly presents, the financial statements fairly presents what's happening, but we're going to specify something specific that's not accurate, and we call that qualified opinion, yeah, or a modified opinion versus unqualified or unmodified. An example would be, let's say there's a certain asset that we cannot determine the impairment for whatever reason, and it's not um, immaterial, not minor, yeah? So we would specify exactly in our opinion what it is that we cannot agree to. But otherwise, the financial statements are fairly presenting what's happening. Now, what you don't want to see is an adverse opinion. And basically, it's saying that something is not going according to accounting rules. Maybe the revenue recognition or expenditures are not being reported properly. A disclaimer is when the auditor cannot even give any one of these other three opinions, yeah? And basically they're not allowed to even do the audit in the first place. And you probably won't even get to this point, a disclaimer, because you won't even be hired to do an audit. So let's take a look at an example for the City and County of Honolulu, their financial statements, specifically the auditor's report. So I always jump to right away the auditor's report. In this case, it's KMH. And I jump to the paragraph that says opinion. So again, here's that phrase I'm looking for, yeah? Fairly, present fairly. I don't see any qualifications here, any specific situation that says otherwise. Okay, so this is that first, yeah? The unmodified, the non-modified. So let's talk about federal required audits. So the federal government has lots of agencies like the Department of Defense, um, Health and Human Services, and it gives these grants or awards to other um, other governments, the so-called state and local governments, or non-profit organizations. So you have lots of programs, lots of departments here receiving lots of grants from lots of different federal agencies. And each one of these grants may require an audit. So there's going to be lots of audits here, but that would be inefficient. So what the government allows, the federal government allows, is so-called a single audit by this one government or one nonprofit for all the federal grants it receives. So here's some limits here. So if the total of those grants come out to 750,000, then this single audit can be consolidated together. Typically, you would have one federal agency coordinating all of the other grants, the other federal awards. We call that the cognizant agency. In the case of the University of Hawaii system, they have received lots of federal grants, over $500 million. And one of the main federal agencies they receive this money from is the Department of Health and Human Services, HHS. They receive more than $50 million worth of grants from this one agency. So this is the cognizant agency that handles or coordinates the single audit for the UH system. Now you're not only just going to audit this HHS grants, but basically sample all the different federal grants for all the different programs in the UH system. So to make sure you have that equal auditing of different agencies, different programs, we divide up our programs into a large or small. In the case of the UH system, the breakdown is between 3 million. Yeah, less than 3 million would be small. More than 3 million of federal grants would be large. And then you also assign a so-called risk to each program. A low risk would be probably one that was audited in a previous year, or a high risk would be something that was never audited before. A low risk was maybe a previous audit that had no errors, no recommendations made, where a high risk would be in a previous audit there were recommendations or some errors were found. Okay, so based upon all of this, they would determine which programs, which grants to audit, and combining it all together into a single audit. Here in this schedule, you can see this is really the bottom of the UH system's single audit expenditure report. Here's the total of all the expenditures and kind of broken down. And again, there's pages of this to get to that total of the different federal agencies and their grants they had given for the year. Uh, Let me stop here, and in the next video, we'll talk about tax rules for tax exempt organizations.